Welcome to this explainer. Today, we're going to do something actually really fascinating. We're zooming way out to understand how these massive, global, macroeconomic forces literally impact your daily budget and your personal investment portfolio. I mean, have you ever caught yourself wondering why absolutely everything suddenly seems so much more expensive? Or why interest rates just shift out of nowhere, completely changing the math on your mortgage overnight? Well, that is macroeconomics at work. And today, we're going to make it simple. Okay, so let's quickly run through today's roadmap. First step, we'll look at the big economic picture. Then, we're diving into inflation and purchasing power, followed by interest rates and stocks. After that, we'll compare two major recessions, 2008 versus COVID. And finally, we'll wrap up with a highly practical retail investor checklist. All right, let's just jump right in with section 1, the big economic picture. We are zooming out to the macro level. You see, macroeconomics, it doesn't really care why one specific product is expensive. Instead, it asks why absolutely everything around us feels more expensive, all at the exact same time. It's the study of the entire economic machine as a whole. We're talking about millions of people and massive, overarching patterns across entire countries, rather than just individual day-to-day choices. And to really understand those massive patterns, you have to look at the circular flow of the economy. Think of it like this. Companies produce goods, right? And they pay wages to their workers. Well, those wages then become household income. And what happens to that income? It gets spent on goods and services, which creates the demand that encourages those exact same companies to produce even more. So the absolutely crucial point here is that production, income, and spending, they form this endless interconnected loop. They aren't separate things at all. They're just different sides of the exact same process. And because of that, if confidence drops and just one part of this loop slows down, say people earn less and start spending less, well, companies reduce their production and the entire system immediately feels the shockwave. Which brings us perfectly to section 2, inflation and purchasing power. This is the invisible force that is actively shrinking your money. Now, when most people hear the word inflation, they usually just think, oh, prices are high. But really, it's about overall prices persistently increasing over time. And that results in this continuous quiet decline in your purchasing power. It's super critical to understand that true inflation isn't just a temporary price shock caused by some brief shortage. It's not like energy prices spiking for a couple of months and then stabilizing. No, inflation is when the overall level of prices just keeps rising year after year. It's a long-term trend, and it completely changes how we actually have to plan for our financial futures. And this brings us to a pretty harsh reality. You'll often hear inflation called a hidden tax on savers. And why is that? It's because your purchasing power, meaning how many actual goods and services your money can physically buy, is declining. So even if the number sitting in your savings account stays exactly the same year after year, during periods of high inflation, its real, actual value is actively shrinking. So sitting on piles of cash for long periods in that kind of environment, it's honestly incredibly risky. Now, I think this validates a massive frustration we all feel, right? You turn on the news and they tell you that official inflation is at, say, 3%. But then you go to the grocery store to buy some eggs, and there feels like a total disconnect. Well, there's a reason for that. Official inflation is essentially an average. It's based on a typical household's basket of goods, known as the Consumer Price Index. But here is the secret. No household is actually perfectly typical. If you spend a massive chunk of your personal income on rent, food, or energy, and those specific things are spiking in price, well, your personal inflation rate is going to be much, much higher than that official average on TV. So you aren't crazy. You are just experiencing your own lived reality of personal inflation. All right, moving on to section 3, interest rates and stocks. Let's look at the macroeconomic domino effect. So when inflation starts running entirely too hot, someone has to step in to fix it. And that someone is the central bank. Think of the Federal Reserve in the US or the European Central Bank. They are essentially the banks of the banks. You and I, we can't just go open checking accounts there. Commercial banks do. And the absolute main responsibility of an independent central bank is maintaining price stability. That means they're the specific institutions tasked with cooling down the economy when inflation gets completely out of control. But how exactly do they cool things down? Well, they use interest rates, and this creates a massive domino effect for us as investors. Let's trace it. When the central bank raises their rates, borrowing suddenly becomes expensive for everyone. Mortgages, car loans, credit cards, it all gets pricier. Naturally, this slows down spending and investment across the board. And finally, this directly causes stock prices to become far less attractive. Why? Because future corporate profits might be lower, and at the same time, newly issued bonds become way more appealing because they're suddenly offering higher yields. Now, conversely, when they lower rates, borrowing gets cheap, and that pushes stock and real estate prices up as all that investment flows right back in. It's a massive chain reaction. Let's shift gears to Section 4, Recessions. We're going to compare 2008 versus COVID to see what happens when the economic cycle essentially breaks. Economies have a natural rhythm, sort of like breathing in and out. And recessions, well, they are the painful contraction phase of that cycle. They're usually marked by at least 2 consecutive quarters of economic decline. Spending drops, consumer confidence completely falls away, and businesses, expecting lower profits, begin layoffs. But here is the thing. While the symptoms of a recession can feel totally identical when you're actually living through them, the underlying causes can be radically, completely different. Just look at the stark difference between 2 major recent recessions. The 2008 financial crisis was a fundamental structural failure. It kicked off when housing prices fell, banks faced massive losses, and lending just completely froze up. The economy basically contracted from the inside out. But the COVID-19 recession, that was a totally different beast. It was an external, biological shock. Lockdowns physically stopped businesses from operating and literally halted spending overnight. And because the root cause was so wildly different, the reaction had to be different too. It prompted massive, immediate government intervention, bringing huge stimulus spending and rapid rate cuts just to keep demand alive. And that brings us to our final part today, Section 5, the Retail Investor Checklist. This is all about turning that broad economic data into a personal strategy. Because let's be real, the goal of understanding macroeconomics isn't to perfectly predict the future with a crystal ball, it's just to make smarter decisions. So here is a highly actionable checklist you can use right now to cut through all that daily news noise. First, track the economic calendar. Know exactly when CPI inflation and GDP numbers are coming out, because those reports move markets. Second, figure out your personal inflation rate based on your own unique spending habits. Third, keep in mind that hidden tax we talked about earlier. Consider shifting from cash into assets during periods of high inflation, so your money doesn't shrink. Fourth, monitor central bank interest rate decisions super closely. And finally, number 5, adjust your stock market expectations based on those borrowing costs. If rates are going up, you should expect stocks to face some serious headwinds. Following this checklist allows you to actually anticipate market moves instead of just blindly reacting to them after the fact. So, we have successfully mapped out how the massive circular flow of the global economy connects directly to the purchasing power inside your very own wallet. I want to leave you with this final, provocative thought to apply to your own budget right now. What is your actual personal inflation rate today? And honestly, are you really prepared for whatever the global economy throws at your wallet next?